US earnings season gets set to start once again for the fourth quarter with results due from Citigroup, Wells Fargo, and JP Morgan on Friday the 15th. According to FactSet, consensus is for S&P 500 earnings per share to have declined by 8.8% year on year in Q4. JP Morgan is expected to report earnings a share of $2.57. That's flat year on year. On revenues were expected to drop slightly to $28.45 billion. Joining me to discuss the bank earnings and plenty of other assets as well is Serge Berger from thesteadytrader.com. Serge, great to chat to you. Let's kick off with bank earnings. What are you expecting? I mean, when we take a look at the chart of JP Morgan, it's made an impressive recovery since the lows in October to the tune of around 45%. What should we see there?
Hey, Victoria, I think in terms of the numbers, which we'll find out later on this week, I think one of the most important things we want to see is what the reserves are that these banks are either going to maybe take down or take up. And that's going to give us a pretty good reading in terms of, how flexible they are in terms of lending when there's actually enough demand for it. In terms of how we are looking to potentially take advantage of a trade here, I think it's important to understand that these banking stocks, and I think I actually touched on them in the last once or twice we talked together, quite bullish on them, and remain quite bullish going forward. But I think in the short term, we're getting into a more difficult situation. So JP Morgan, for its part, it just reached a fresh all-time high just the other day. And this happened as the 10-year U.S. Treasury note, the yield on that, pierced above 1.1% towards 1.15%, which of course is a big move from the bare 50 basis points it was just in August. So that chart of yields going higher and bank stocks going higher is more or less the same, as you can see here with yields at the bottom and the stock price at the top. I suspect at this point, from a pure trading perspective, that's what we're doing. We took full profits on these names just the other day, and we're now going to see how these names react after earnings. In an ideal situation, from a trading perspective, we'd like to see another rally so they get even more rebought, so that we can then potentially short them for a trade before getting long again, maybe into the spring. But I think equally important here is what bond yields do. My sense is that bond yields are short-term overbought. Hence, if bond yields go a bit lower, I would suspect JP Morgan and some of these bank stocks could take a pause as well.
Let's talk about your outlook for gold as well, because we've seen it come under quite a lot of pressure essentially since August. It's come off by about 10%. Nonetheless, it still is significantly above that low from March. What's your sort of short-term outlook on gold and possibly a longer-term view as well?
Yeah, sure. I mean, I'll just for just a second take a step back. I think what's important to understand is that what's really driving gold ultimately, and it's going to drive gold, is the amount of money in the system, the M1 or M2 money supply, depending on how you measure it. I think it's about 70-75% of dollars were created in the past 10 years. A lot of money slushing around. And I think ultimately that's going to be what drives gold higher. And we see also a lot of people getting more and more speculative from buying more call options and buying, lower and lower price stocks such as this. People essentially, buying a lot of low price stocks. So these kinds of things, I think, ultimately is what is going to drive gold higher. I suspect that while we continue to reflate over the next few months with bond yields going somewhat higher and equities holding in there, although we could see a drawdown in immediate term, I suspect that gold remains roughly range bound for the immediate to near term. I'm just looking at the gold futures here, but more or less, obviously, you can extrapolate this into spot. But I suspect more or less somewhere around 1750 to 1950, maybe even 1800, or 1975 or so remains the range. I think we need to see some of the exuberance coming out of the equity bubble and yields to potentially peak in order for gold to start having a meaningful leg higher again, which I'd fully expect to happen at some point later on this year.
And what's the sort of read across for silver? What's your outlook there?
Silver is at least as interesting, and what I'll do here is I'll bring up the chart here for this one as well. But I think, silver, not only is there the correlation through a longer term for gold, but there's also an industrial use. And I know this is being, discussed a lot, but I'm probably more bullish in silver than gold even. I think that silver could easily go into the mid to high 30s at some point this year. That doesn't seem like a big move, but it actually is a big move in terms of percentage terms. Silver is more volatile than gold, so we have to keep that in mind. But again, I think as we start to see not only the economy recover, but also some of these inflationary pressures, and ultimately, the amount of money in the system really kind of giving way to an escape to all this, meaning basically the debasing that's happening, monetary debasing, money's going to find itself into silver and gold and some other asset classes around that.
All right. And then finally, in terms of some individual stocks, Twitter has been one to watch this week. Certainly quite a lot of downside pressure after Trump's account was essentially banned over the weekend. Twitter is a stock that's been performing pretty well lately since those March lows of last year, but now it appears to have really turned in the other direction. Do you see more downside from here?
I think when we look at Twitter, it's very easy to just say, kind of assume that the ban of his account this year is this week is sort of the end of Twitter, and I just don't see that. I think if you look at the amount of the user base continues to grow, it's much more than that. It's not just politics. It's at least as much sports and finance and many other things. So I think once we get past this, what I think is more of a near-term hurdle from a headline perspective, I think the people will start to see the value in this again from an investing perspective. If you look at the chart, just in terms of seeing how I might be able to profit from it and where the stock is, you can see that for the most part, Twitter found resistance roughly at its long-term resistance area in the mid to low 50s. But if you look at it a bit closer, it actually has just found support kind of where, from a technical perspective, it should, which is roughly around the mid 40s. I suspect I'd like to see some confirmation buying come in before we get into a new position. We're currently flat this, but I do think ultimately we could easily work ourselves back up towards above the mid 50s and into the 60s in due time.
And then finally, I know another stock that you've been paying close attention to has been DraftKings. We've been seeing quite a lot of buying recently. Do you expect that to continue? Yeah,
I mean, I think the DraftKings story is this is essentially sports betting as people are sitting at home and not being able to do anything. The retail community is hot for these kinds of stocks, for one, because they can understand it, and number two, they're doing it. They're participating in what these companies do themselves. This is a simple chart. All else being equal, if the retail frenzy continues, which I think it will for the next few months, immediate term, potentially some drawbacks, some drawdowns, I think ultimately the stock will easily go towards 60 and 65, all else being equal.
All right, Serge, thank you so much for all of your analysis. As always, it was great to chat to you.
Thank you.
That was Serge Berger from thesteadytrader.com. I'm Victoria Scholar, and thanks so much for watching IGTV. For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.